Hello active traders, and welcome to Entries and Exits, Breakout Trading Success Strategies for Active Traders. This is Ken Calhoun, your host, coming at you live here on April 20th, 2013. I wanted to thank you all for being here and for participating in the earlier events. As always, all information is for educational or information use only. For those of you new to working with me, you may have seen me for the last decade in active traders, stocks and commodities, and at the expos. Here's our agenda for today. And I want to go step by step and slow enough so that everybody understands very clearly exactly what to do, how to scan for what's worth trading in the first place. I'll give you some strategies, tips across markets for stock and ETF day and swing trades, as well as Forex day and swing trades and E-mini intraday trades. So we're going to look at how to scan for what's worth trading, how to avoid false breakouts, updated tips for what's going on in current markets, how to enter your trades, momentum price action patterns to use, at least the ones I do in my own trades. I'll show you my favorite ones and the ones that I've used the most consistently, and also how to exit your trades, not only the secrets for tight stops, but how to scale in and out, so trade management for entering and exiting your trades as well. Let me start off with the question. What is your biggest challenge when it comes to, let's start off with scanning. What's your personal biggest challenge when it comes to finding out what's worth trading in the first place? I give away, my favorite tips in the Saturday week ahead events, but what's your biggest personal trading challenge when it comes to scanning for what's worth entering in the first place? Go ahead and post, and I will answer those and give you some tips as a bonus after I present. Let's start off with step-by-step scanning, what to do. Step-by-step. One of the first things you want to start doing is you can look for 52-week highs, okay, in scanning. Look for 52-week highs in sites like stockcharts.com, finviz.com, bigcharts.com, and your charting software's leaderboard. That's a good place to look for entries. Parameters. Swing trading. For swing trades, I want you to look for things that are trading over 1 million shares, over 20 a share. For day trading, has to be over 15,000 shares per minute. That's for stocks and ETFs. We'll do the other markets coming right up. And again, over 20 a share with at least a 1 point prior day's range. Okay, and for this, preferably at least a 10% range on a 15-day chart. 3 to 4 points or better, okay? And if you put those simple parameters around what you're looking for stock and ETF trades, that should hopefully help keep you out of the bad instruments that are not worth trading, okay? Entry patterns, and we're going to, again, I'm just kind of notating some of the things here because I know a lot of folks that asked for notes and so forth. Entry patterns. Day trades 0.08 to 0.35 above prior day's high on days in which S&P, NASDAQ also at 2-day highs. Swing trades, 15-day high breakouts, 50 cents above nearest whole number. And these are just some of the parameters, if I were to get some software developed, these are the types of things that I would put in a scanning program. This is what I want you to learn, though. This is, and again, I've done this for many, many, many years. These are the very consistent, the types of things for scanning that you want to do. Forex, 7-day highs, entry signals 20 to 30 pips above 7-day high for swings. For scalps, intraday, look for micro cup breakouts, 10 pips above highs. Risk management too. Never more than 20 to 30 pips stops. Day trades, no more than 0.10 to 40 cent stops for day trades. For swing trades, no more than 1.5 points max swing stock trades. Okay, and for E-minis, we're going to look at charts next, but I wanted to just intraday scalping, 6 ticks above micro cup pattern highs to enter. Use 1 to 2 point ranges, and there's a few techniques that you use for that. Stops maximum 3 to 6 ticks on E-mini for intraday day trades. Okay, so that's kind of a top-down look at some of the parameters that I use, at least in my own trades across these markets, for what to look for and how to scan for it. And so, having said that, and I will give you that. I will send you a link to this, the notepad file too. I saved this and I will send you these notes too. But let's go ahead and take a look at some of the charts that are worth trading and those that aren't, and figure out a strategy. You know, what I want to give you is kind of step by step. So it's a step by step what to look for, okay, how to look for it. You can get the data for what's worth trading from, you know, a variety of, you know, free websites or using your stock, you know, your stock charting software leaderboard scans. So having said that, for example, percent gainers. Who can give me an example of one of these that's at least $20 a share? I like to make this interactive. I used to be a corporate trainer, and I like to make people think, not just watch it as over a TV show. You learn best by actively engaging. That's what I used to teach when I was an MBA prof too. Give me an example of one of these that's over $20 a share and over 1 million shares a day. There's quite a few of them, but just pick one. What's one that's over, and look at the last column for the price, and this is the volume. So where's one that's at least $20 a share and over 1 million a day? Okay, SEAS, Celgene, CE, Capital One, EVDC, J&J. Okay, right. So we would not be looking at those charts. We're looking at those that are over 20 a share, okay, like this RH, SEAS. Interesting. I don't see any other data. So I wouldn't trade that. The other thing you want to do when you're scanning is look for the immediate past strength of uptrend. So for example, this one, RH, Restoration Hardware Holdings, whatever that is, I wouldn't trade in a million years because this is a really bad weak chart, right? Look at all the sell pressure there. Yeah, I got some buyers Friday, but so what? Be a skeptic. I wouldn't trade it. So when it comes to scanning, same thing here, RNF. So that's the second. So the first one is the price action and the volume good enough to be worth considering in the first place? Over 20 a share and at least 1 million. Second thing you want to do, okay, so stock swing trading walkthrough. Step 1 is at least 1 million shares a day volume, over 20 a share. If yes, then step 2, 15-day chart in a strong enough, and that's kind of the key word, strong enough uptrend to justify an entry. And one of the things that traders get into trouble with, and I used to do this too, is you get all excited about this day. Woo, look at that, it moved. Hey. Well, I mean, for day trading, sure, you could scalp it, but for swing trades, you have to have the story of what I teach my traders in my other courses too, is you're looking for the story of buy and sell pressure in that instrument. So this very clearly ties to things like avoiding false breakouts. You're going to get a false breakout most of the time if you're trading flat instruments that just suddenly came to life as a result of a minor gap or something that's had a price reversal. So I would not swing trade any of these charts. Not a single blessed one. Okay, because I would trade the ones that I gave you in the week ahead for those of you who are in that, right? The ones like, for example, Disney. So that's where, because that's a good, strong enough uptrend, and it's at a 15-day high. So do you see the difference? That's where things like the scanners, like this, percent gainers or whatever the gain-loss list, can lead traders astray, because, you may be off looking at this one and, well, hey, it looks like it moved up, and hopefully you think it'll keep going. No. This is a story of sellers in the house. I mean, it just got a short covering pop and the gap continued. And if you happen to be day trading, it good for you. But for swing traders, you're not going to be on the right side of this. So X out these type of tools. Make sure that you are doing a careful study of very quickly. I mean, it's not like, I don't agonize. I mean, I look at this. As long as it takes me to make a trade decision, I'll buy it at, say, 70.5, 70.6. I'd put a stop at 69.50. I'd scale up at 72.5. And that's as much thinking as I'm going to put into how to trade this one. So maybe trading 15 others as well. And so I'm not going to sit there and put in all kinds of oscillation indicators and, hey, Bollinger Band's that, and MACD divergence is doing this, and RSI and stochastics are doing that, and they blah, blah, blah. That's not how you trade. How you really trade is trade what's strong and hit it, and diversify and use real tight stops. So does everyone see the kind of the hazard of, and I've never revealed that in any of my other events before, but the hazard of just blindly using leaderboard scans? Many of these would be disqualified because of previous choppiness of price action. This one's a little better than the others, but it's still sideways enough to where the story of internal buy and sell pressure is evidenced by lack of consistent trend is not good for those, but it's much better for instruments like the Disney or, even Amgen and Celgene pulled back. So that's why they're not on the swing trading watch list. But things like Nu Skin, right? So when it comes to scanning, make sure make sure there's at least 3 to 5 days of continuous buy action, higher highs, prior to entering a trade. Avoid charts that are sideways with recent 1 to 2 days price action up. What I call isolated gaps or spikes. You want to avoid those type of charts. So from a scanning standpoint, that's one of the things that you want to do carefully for entries and exits. Now, when you're looking at, for example, say if I'm looking at one of my Forex charts for a trade setup, yeah, this one's fine. It was one of my picks, the dollar CAD. And for example, the cable's no good here. I mean, and for selling too, it would be no good. Who could tell me? Why would I not want to short this pound dollar chart on new lows down here? Why would 152 likely be a bonehead short? Why would I not want to short it down there? I mean, that is new lows after all. Be like a detective. I just finished up watching seasons 3 and 4 again of Castle, which is a great TV series with Nathan Fillion and a bunch of other people. Anyway, be a detective. You come on the crime scene, and what are the clues that tell you, hey, what was the alibi window for one suspect that clears them? What's something that, motive opportunity means for a chart? Well, anyway, apply it to trading. I have too much buying here, too much buying. Same thing on buy charts that have big pockets of sell pressure like we saw in that stock chart scan. In Forex, because you have all this buy, and I've never covered this in any of my other Forex training, I want to give you guys something new and genuinely valuable that you can actually trade with and use as a professional trader or an upcoming professional trader. When you see the story of this is, although it's a downtrend, we have too much buying pressure here. So we're likely to get a false breakdown, much more likely to get a false breakdown there. It's likely to, say, drop down to 150.18 and then spike up against you. So you just skip it. Avoid the bad part of town. Avoid the questionable neighborhoods. Just don't go there. Here we have an uptrend followed by 50% pullback and a continuation. This one's okay because the strength of the sellers is only a very small percentage of the price action in the high and low, right? This is about 30% of the price action. This is a story of relatively strong selling, or strong buying, I should say. The selling here, relatively weak selling in face of this buy pressure. So this is one that's better for an uptrend. This one's better still, right? Now, one of the other scans to look for, and the way to adjust for your entries and exits, if you see a large bullish cut pattern that is not as good, okay, that is not as good as the previous chart, or like this one, the Euro CAD, or the dollar CAD for that matter, was the previous chart, we have mostly buyers in the house, and any selling is relatively narrow. So when you're scanning and to avoid false breakouts is another tip for managing entries and exits. We'll cover how to set specific entry triggers coming up in a second, but the first battle to get right is to trade the right instruments in the right directional way, first, and stay clear of anything that's questionable or iffy, kind of the potholes in the road or the accident on the side of the road you have to swerve around. Make sure that you're not trading deeply pocketed instruments, either to, in this case, would be deeply pocketed to the upside on a sell. Widely up and down instruments, they're great for day trading, but really bad for swings. So make sure that you're correctly identifying entry and exit strength and using that as part of what you do as a trader. Does everyone get that so far? I mean, these are, again, I can just tell you off the top of my head like I did here. This is how I trade. I know how I trade, so I can just instantly document, put it down for you guys. This is how you trade. This is what you do. You don't need special software that magically does your thinking for you. Okay, that doesn't work. That ends badly. Kind of like drinking the wrong cup in that Indiana Jones movie. It ended badly for him. You don't want to do that. You want to, figure this stuff out and be on the right side of it more often than not. And then keep small stops for any times that you're not, right? And that's how you do it. So those are the type of things. And make sure that you're looking at the story of price action. And if you're, let's say you're looking at, say, for intraday trades, and we know that we want to look at 2-day highs. One of the things that gets traders in trouble is they will over trade choppy instruments. And my favorite ones for the week ahead, whatever, MRK was a good one. Yeah, that's a good one. Yeah, that's good for day trading. Or VZ, that's a really good one. Another thing to look at, and this is for day trading, look at the strength of how clean and wide single length runs is. Okay, so for intraday trading, step one, how wide and clean, how far does a micro trend run in one direction before pulling back or chopping around. Okay, so, and what I do whenever I'm doing my day trades is I'm looking to be, and the whole reason that you buy is because you anticipate new buyers coming in after you. So obviously you don't say, the first step is how far does this thing run in a single move? It's roughly 50 cents, right? 51.50 up to 52. So this has a 50-cent run. So if I bought 52.50, quiz question, where would I look to be selling? At the best case, and again, maybe half the time I'll only get half of it, but best case, where am I going to be selling to? Who am I going to be selling to? I'm going to be selling to buyers where? Given that, again, you do price action characterization is what we call it in engineering, but you characterize parameters, you characterize length of run based on the most immediate, urgent previous data set that you have to work with, because previous behavior is the best predictor of future behavior, as with people, right? If they're not a really good person and they argue too much, they're likely to be like that 20 years from now. They're not likely to change. A leopard doesn't change their spots. That's why with people, it's good to take small stops too. How many of you have ever worked for a boss who was a total asshole? Anybody? Forgive my French. I know I have. I've had 2 really good bosses and 2 real assholes. Okay, well, the best thing to do is, I don't know, get fired or quit. Yeah, I've had that happen to me numerous times. If you're in a bad marriage or a bad personal relationship or whatever, they're not going to change, and you're not going to change them. The sooner you learn that, the better. The best solution is to change channels. Click. Imagine your life has a remote control, and you can change channels. Now, as much as you'd like to push the mute button and shut somebody up, that ain't going to happen. You're best to change the channel, walk out the door, or show them the door, whatever it is. Well, anyway, the reason I'm saying that, so on the lighter side, is that typically you're going to see the same kind of price action patterns. See, for example, 50-cent run there, 50-cent run there. What do you think is going to happen next day? So, yeah, you're right. The selling would be into 53, right? 52.90. Vin has it. Theodora just slightly up, 53.2. Right, 53 and a quarter, 53, 53, 53.01. Hey, Joel, BC, Paul, Ray, thanks. Yeah, you guys are right. So the 50-cent run there, that means if I buy 52.50, I'm going to be tightening a trailing stop at, say, 52.8, 52.9 with anticipation that it's going to run out of steam near 53. I may well get in again over 53 and a dime or 53 and a quarter if it keeps running on up later. But for the first leg of the run up, I'm going to kind of cut and paste this single length run and use that as my best case scenario. You know, it may well just chop. It may not continue to run up. Best case is going to be here. Where traders get into trouble is, you know, they'll look at the entire day's range and say, well, hey, this thing has a 2-point range, so all I need to do is get in at 52.50 and it may run up to 54. But no, it may run up to 53 and then you get out. And one of the things you learn in day trades, and this applies to swing trading too, and we'll go over swing trading charts, is you're looking to get out at the price extension runs on single length trends. And that's from an entry and exit mechanics of the trade, that's one of the things to get right. The other is, from a scanning standpoint, only choose to trade instruments that do have nice, strong, characterized length of runs like that one. Okay, like VZ or MRK, right? Same thing. This moved as much as what? 46.7 to 47.10. So that's 50 cents in a run, right? Same thing here, 47 up to 47.50, 50 cents. That's a 50-cent run, 46.7 to the 47.10. Actually, that's 40-cent run. So anyway, 40 cents here, 50 cents there. That's as much as it's likely to run here. So if I buy 47.6, I'm going to sell near 48 because I'm going to expect at best case a 40-cent run, either on the opening range or later in the session. I'm not going to try and shoot for the entire thing. Now, when it comes to swing trades, price extension moves are similar. One of the things that you want to do, you know, again, previous resistance, new support, it takes off there, trading 101 stuff. The life of your swing trade, and this is very important that you get this, swing trade exit targets. I don't like exit targets because they keep traders in too long, but swing trade, best case exit target is what? Who can tell me? It's what percent? I haven't told you yet. If you're new to working with me, you won't know this. If you've been with me a few years, of a 15-day chart. We have some adjustments to this, but it's 50%. The answer is 50% of a 15-day chart. Okay, so for example, in Disney, the entire 15-day high-low region is 56 to 61 and a quarter. You can round up to 62. So it's got a 6-point maximum range on a 15-day chart. The best it's going to run is what? Do you see this? This is exactly, mathematically, that's the cup pattern, that's the cup high, 3 points, 57.8 to 60.8. Guess this should be nudged up just a tad here, but okay, 60.8, whatever. So it's a 3-point run. So when you're swing trading, let's say if you buy 62, where are you going to sell? I'm just kind of rounding. If you bought at 62, given that your exit target's at best 50% of the run, how are you going to scale out? This is an exit tactic, right? This is exiting the trade. Entries, I taught you how to get in on these, 30 to 50 cents above whole numbers. But if we bought 62, where would we expect to get out? 62 plus 3 points is, the magic number is what? You start to scale out. Sophisticated would be, example, Disney walkthrough, Diz. With the 6-point 15-day chart range, that's the high to low on a 15-day chart, 50% of 6 points equals 3 points. So if I buy at 62, my exit target or trade expectancy is going to be mapped out at 65, right? Meaning, okay, and that's kind of basic, meaning don't buy between It means a couple of things. This is the thinking, this is the smart part of how professional trading. Meaning this is the more important thing to get right is use that price extension approach to figure out from an entry standpoint, we don't buy between 64 and 65 because that's too close to the anticipated price action exhaustion. Okay, it's likely to stall out between 64 and 65 as I'm selling to you. You know, if I buy the 62, I'm going to be closing it out and selling to you collectively, the trading community, between 64 and 65. Closer to 65 if I can get it, but I'll start scaling out at anywhere over 64. So that's a bad place to be a buyer because it's likely to stall out and fade back at 65 and do another one of these pullbacks or sideways chops that would cause a stop. Okay? What that also means, so how to, mechanics of the trade, tip 1 is don't buy there. Tip 2 is scale in, or as my colleague Van Tharp would call, position size in over the 65 by at least 50 to 75 cents. So let me just round it to 65. So a second entry is, say, 65.50 with a stop at, and I would use no more than 1 point down, 64.5. So if I buy one at 62, and if I sell it all at 64 to 65, good, I made a few points on a swing. But if it keeps running on up, then I buy two at, say, 64.5. Now trail stop at, I'm sorry, at the 65.5. And I put the trailing stop at 64.50. And then use a 1 point trailing stop on all open swing trade longs. And again, you can extrapolate that for any market that you trade, but that's kind of the mechanics of the trade, or at least how to do it. Okay. And again, note that the beauty and the simplicity and the professional approach for all this stuff is we're trading wide range volatile instruments that, and again, I'm not saying that Disney's going to keep going up. Disney maybe this is the exact top and it tops out at 62 and sells on off down to 30 from here. I don't predict, right? Just because it's going up doesn't mean it's going to keep going up. Learned that the hard way a few times. But if it does keep going up, that's how I would play this. Okay. Let's take a look at this Merck chart. Same thing, 47.6 to 43.6. So question number 1, is this worth trading? Well, barely. It doesn't have at least a 10% range, but it does have, well, actually it does. It has exactly 10% range. It's got 4 points on a $40 instrument, so that's right close to 10%. So that's good. So we have at least enough points to work with. I don't like charts that only have a 1 or 2 point range. Okay, this has a 4 point range. So what I like to do is the 4 point range, how far does this thing move in a single run? 45.2 to what, 47.2? So it's got a 2 point entry and exit pattern. So let's walk through this one. Again, I want to give you step by step how to do this. Good professional trading approach. You want to walk through with a 4 point 15-day chart range. 50% of 4 points equals 2 points. And by the way, is this good in terms of kind of step by step what you guys are asking for in the survey? I got a lot of requests from people that I should document some of this stuff and give you step by step and not kind of hop around all over the charts like I want to do. That's how I trade, though. I mean, I'm all over the charts. I'm all over the markets, rapidly firing stuff off. But I want to kind of give you the step by step. I've been trying to learn some new music software, and it's overwhelming at first, and there's all this stuff, and there's no step by step, so you got to kind of piece it together. It would help if I had a step 1 do this, step 2 do this. I'm kind of break it down. Okay, thanks. Got a lot of yes. Excellent step by step. This is great. Very helpful. Very good. Great. Yes, thanks. Thanks, guys. I'm reading off. It's very helpful. Thank you. So we can go over it later as homework, right? Yes, thank you. Yes, step by step. Okay, good. I will keep doing step by step because I think that's when I'm trying to learn something new like this blasted music software. I bought some really expensive professional musician software, 2 different packages this last week, and I am having a heck of a time figuring that stuff out. And it's the instruction manual doesn't really help. It would be nice if someone would say, hey, step number 1, import your MIDI track doing this. click this button, press that, do that. So I can relate. You know, trying to learn something complicated and new. It's good to have the step-by-step walkthrough. So, okay, so if I buy this at, where did I hit this thing? Where did I buy? Yeah, let's say 48. Let's round up to the nearest whole number. So if I buy at 48, my exit, target, trade expectancy is at where? See, where traders get in trouble is they look at the entire previous range and think, well, hey, I'm going to shoot for the whole 4 points. And then they hold through a reversal and the trade goes back to break even or they take a stop. And what I want you to get in the habit of doing, this is how I've made the most money in my winning trades, is always getting out at my expected price action extension ranges. And I just manually figure that stuff out by eyeballing the chart and using price elasticity patterns to help me with my entries and exits. So, you know, I'm not using any special fancy indicator to get me out. I'm just using price. I'm a price action breakout trader. That's what I do. So, yeah, so right. So the expected outcome is 50, right? That's the, so meaning, same thing. Tip 1, don't buy between 49 and 50 within that last point of the run, too close to anticipated exhaustion. Tip 2 is therefore scale in, add to the winning trade, position size in, however you want to call it, over the 50 by at least 50 cents. So it's kind of a template, right? So the second entry is at 50.5 with a stop at where? Around 49.50, right? 49.50. And that's how you set up the trades, right? And then, you know, the challenge as a trader is avoiding false breakouts and figuring how to scale in a way that helps you survive a pullback. Okay, and that's the biggest challenge as a trader. At least that's my biggest challenge in my own accounts is, you know, okay, well, let's say I buy the 47, I'm sorry, if I buy the 48, somewhere over 47, let's say I buy 48, and then I buy again right over the 50, but then it starts to misbehave and sell back down. What now? Well, the answer is always get out fast, soon. You can always buy a new high breakout. When in doubt, get out. And I would highly recommend, this is an honest recommendation, and I'm telling my family or friends this, highly recommend get, I don't know, Post-its, or I use shipping labels because they work really well. 3 to 4 of them. Use a Sharpie marker to put reminders that you stick to the edge of your monitors, saying things like, hey, maximum stops. 1 point for swings, 0.40 cents for intraday, 8 cents is better, 8 to 10 cents, 6 ticks for ES, 20 to 30 pips for Forex, whatever you're trading. So I have maximum stops as a visual reminder somewhere, and this helps with entries and exits because it keeps you in the right, hopefully it keeps you in the, it builds discipline, right? You don't need to go reading books and buying courses on how to be a disciplined trader. Instead, you know, make visual reminders, right? If you're like me, we're all kind of visual people. We relate to visual cues in our work environment. So what I do to operationalize that or bring it to life is, and I've done this since the 90s, I put little stickers in the edges of my monitors, and don't use marker, and say, don't use an ink pen or pencil because you won't see it. Use a Sharpie marker or one of the those whiteboard dry erase markers. Maximum stops. And I say things like this: take profits early and often. When in doubt, get out. Small stops is one that I always had in caps. That's what helped build my success as a trader. I'd always just write small stops, right? And if you're, and if you're new to trading, then, or you're not being successful as a trader, put those values down and make sure you follow those things, and have small stops. The rest of it, C. Favorite entry patterns, like buy minor gaps up, or cut breakout entries. So that's just kind of like a bonus tip of trading, the life as a trader. I'll tell you, these are the kind of things you want to do is put, how many of you are doing this, by the way? I'm curious. It's something I've done myself, and I have recommended to traders many, many years ago. I haven't really mentioned it lately, the last 2 or 3 years, but that's something that I would encourage you to do is put little visual reminders around your trading workstation and, be on the right side of this stuff. It's something that can help. Okay, now let's get back to the charts, but I wanted to just give you some good tips. Now let's look at avoiding false breakouts and some tips. Oh, no, thanks, Bill. Yeah, the videos on YouTube helps with the music software. You're right, tutorial. Yeah, the name of the softwares and tutorial really helps, yeah. Okay, let's move on. Avoiding false breakouts. One of the things that really helps is, and I want to start with the dailies and then get down to the swings. One of the acceleration patterns that I want you to look for, and by that I mean just something that helps you get in on strong momentum breakouts and hopefully avoid false breakouts, is look for wide range candles following narrow candles. The other thing I want you to look for, however, is pause for dramatic effect as I'm finding a chart here for you guys. One of the things I want you to start looking for is price action near the 50 MAs on the daily chart. That's one thing to look at. And give preference to those, for example, that behave themselves and find support every time it bounces off of a 50 MA line. If you're a pivot trader, that's my favorite play. It's a hammer at a 50 moving average line, right? That's my favorite long pivot play. And I'll get in, say, 50 cents above that hammer high. So that's one thing to look at. The other I mentioned earlier is a wide range candle, where you see a candle whose whole real body is at least twice the height of a previous candle. One of the other things to look for is not a classic bullish engulfing, but one in which, well, this one is a bullish engulfing because it's following a downtrend, but anytime price action outdoes or eclipses the closing price range. Okay, what I mean by that is this. What you do is pull up a 2-day chart, pull up a 2-day chart, look at closing 30-minute range, look for engulfing patterns taking out new highs for early entries to scale into breakouts. Okay? Okay, so what I mean by that is this. When you see something that opens under the 30-minute, use this last 30-minute ledge, and you can do this for your swings too. I mean, for swings, you just, you're buying the new high on the 2-day continuation. If you happen to be in front of your charts either early in the session or you see this particular pattern, this is good for a swing trade long entry continuation play. And this is the pattern. You see the last 30 minutes or so of the trading day is eclipsed with the price action starts from below that technical edge. See that? And then it breaks out above. That's usually a very good strong engulfment or engulfing upside pattern. And so when you see those, you don't see them all the time, but when you do see them, like here, right? It starts down here, so you just mark out that 30 minutes. Can everybody, does that make sense? Can everyone follow that? As the main thing is, whatever the last 30 minutes is, it starts from below, it punches through it, it takes out the new high, and then you get in on new highs. Either if you're day trading in and out of these, or you're looking for a swing trade. That's a particularly good, effective entry pattern that I'm seeing in our current markets that has produced some really good moves. So as you're looking for these, so for example, the closing, I guess that's not a full 30 minutes. The 30 minutes would be back here. But still, it started from below the closing range and punched above it. Those usually produce really good moves. So that's another good rider downer in terms of something that moves. Now, The way to do this is just use a simple 2-day chart. Whenever you see one of these where the price action eclipses, it's better if it starts off, not starts here and then does a bullish cup. If it starts down there and then punches through it, that's strong. This is also good, though. Anytime you have this engulfment pattern, and it's just kind of a range in which price action starts off below the previous closing 30-minute range and eclipses that or cycles above it, that's good. If you happen to be in front of your monitors and you're day trading, great. If not, it's still good for a swing trade. You know, let's say 30 to 50 cents above this entire 2-day high. I would say 61 and a quarter would be up at the new high. Anyway, so that engulfment pattern is a good one that I'm seeing in our current markets as well. So anytime you see that eclipse or that engulfment, it starts from below. Right, here's the last 30-minute region. Starts from below, starts its life here, it comes up and eclipses that price action. That triggers institutional HFT programs, and that's one thing, the high-frequency trading algos and dark pools and liquidity traps and all that kind of stuff. Anyway, when you're looking at eclipsed, these are kind of eclipsed open range breakouts or eclipse engulfing patterns. That's another good one to scan for when it comes to hopefully avoiding false breakouts and managing entries as you're visually scanning. Now, do you notice, too, from a price action standpoint, this is not something where there's some commercial scanner out there that does it. You know, as a working trader, you know, I roll up my sleeves, so to speak, and I eyeball the charts, and I'm looking for these patterns. So, for example, another quick tip is we don't want to buy right under whole numbers. So, let's say come Monday, and this thing opens at 61.3. Where would you be interested in buying at first? I like to do interactive quiz charts too, so that you're thinking and not just like watching like it's a TV show. I want you to actually learn how to really do this stuff. So let's go through some quiz charts. And again, all answers are safe. I'm not going to bite off your head for answering the wrong thing. I'm an educator. I've trained tens of thousands of people. It's a safe learning environment, and your answers are all private. So, you know, how much better can it get? And I'm a professional trader and teaching you guys how to do this. So I'm not going to say, because I always, even with my guys who've been with me 5 or 8 years, I always still get variance in the answers. I still get variation. So don't worry about it. Just take a shot. Where would you buy above? If it opens down here, kind of down here, it opens down there. Remember, as a pattern day trader or pattern swing trader, you know, for example, if I'm setting up my buy stop limit orders in my Fidelity SEP, which I trade all the time for swing trades, this is how I'd go about setting up my buy stop orders to hit, say, Monday or Tuesday or whenever the swing trade hits. So even if I'm not in front of the chart during the opening range breakout on Monday morning, I'll still get in on my swing. All right? So yeah, you guys got it. Yeah, right over the 62. I see a lot of 62.10, 62.40, 62.05, and the rest of it. 62.50 is the safest one, right? That would be good. But yeah, the earliest that you'd get in, if you want an early shot, is anywhere over 62. So 62, 62 and a dime, that eclipsed it. Remember, oh yeah, and I got a lot of you who are new to working with me. Nines are evil to buy. Just don't buy anything with a 9 in it, because that looks expensive to anyone who is, say, long from here, and they'll sell to you at a 9. So don't buy 61.95. That would kind of not work out nicely for you. Probably, again, see, I mean, you know, don't take my word for it. Test it out with a few thousand trades, and you'll see. But see how they sold it at the 61.9 here? See that? 61.9 pulled back right off the 9. I've taught thousands of traders to sell at 9s and not buy till it punches over a whole number. So that's why, you know, you guys don't want to do that. So don't buy 61.90. Wait for somewhere over 62 for trade 1, and then Lisa's exactly right. Over 62.50 would be a good secondary. So I introduced the concept. Let's say something like this. I would be okay day trading this over, say, a dime above, anywhere from 8 to 30 cents above the high. So the closing range value here, the last 20, 30 minutes or so, first, you know, step number 1 is, write this down for you guys. Step 1, mark out support, resistance during last 15 to 30 minutes. Let me make that, I think this, I want to give you guys the strongest signals. If you're an advanced trader, use 15 minutes. Everyone else, 30 minutes. during the last 30 minutes. Let me give you the strongest of what's out there to start off with. And then the more experience you get, another good insight, the more experience you get as a trader, the tighter you trade, the more fine-tuning, razor's edge stuff you trade. But so many traders, struggle with just getting the strongest instruments correctly traded. I want to, kind of start off with, the strongest of that. But so what I'm saying is, if you're an advanced trader, look at the last 10 to 15 minutes. If you're a regular trader, look at the last 30-minute range, okay? Where's support? Where's resistance? Okay. Set entry, 10 cents above, or for shorts, 10 cents below closing range triggers, or the box range. And that's good for day and swing trades, okay? Reminder, avoid anything with nines. So don't buy 29.x, 39.x priced stocks, or, say 25.9x or 27.9x. Don't buy any 9 price action, because people who were already long from earlier will be selling to traders at those areas right under whole number resistance, okay? And that's a good professional approach. That's something to look at too. So, okay, what else we got? So that's another one to put, entries and exits. And that's also how to use tight stops. If you're looking at, let me do a couple of Forex examples too, because we got currency traders in the house. One of the things you want to look at is how especially well that works in your FX trades. If you're looking at, say, the closing range, and for Forex traders, I want you to use Forex traders use 20 pips outside of closing ranges. Now with the 24-hour market, use it for the time interval that you're trading. Okay, ES traders use 6 ticks outside of closing or immediate past trading range that you're looking at for your entries and exits. And develop a very good, thoughtful, strategic, step-by-step approach that hopefully gets you in on the right side of these things and keeps you out of trouble, because what you're looking for is set up, and this is good for scalping too, set up the trading range and look for moves right outside of it. Make sure that as you're setting up what's worth trading in the first place, make sure you have at least a 2 to 3 day trend in favor before you look for entries, because what you don't want to do is trade right after a pullback. So that'll usually do a false breakout or another false breakout. Here's another good, kind of a tip for advanced stops and entry and exit mechanics. The mechanics of the trade. If you see a spike or you see a series of spikes like this, you don't generally want to trade that as a breakout play, because you're likely to do what? It's likely to drift up here, spike up here, maybe you get in at the first sign of a breakout, and then it does yet another price action spike. So to avoid false breakouts, avoid instruments that have quick spikes up, or if you do want to trade those, one of the things that I tell my traders is you want to look for pivots off of, if you have a hammer pattern off of an obvious support level, still use a 20 pip above that, that hammer high to get in on a trade. If you see any kind of spikes like this, so that's the tip, and that's good for any market trading, whether you're stocks, ETFs, E-minis, whatever you're trading. You see these kind of spikes in the pattern, avoid those charts in the first place. Instead, trade clean line breakouts. So for example, this one does not have any spikes. The euro-yen, this one is a much cleaner uptrend, right, on new highs. So because there's no false breakout spikes, as I call them, this is the first time I have taught traders this. You see a shooting star right there, right, which put in the high, but I don't see any spikes. I don't see any, suspiciously pullback spikes. When this thing moves, it moves this far, same exact height and pips. So next time it moves, say over the 130.4, that one's likely to continue. May get a little bit of trouble or pull back here near the 131.1, but that's still worth getting into for an entry because this one does not have the kind of price action spikes that the previous chart had. Okay, so to avoid false breakouts, use that as a visual planning tool to help you get in on your trades. Notice too that the approach that I teach traders, and I'm grateful that it's been so popular, so many thousands of y'all, is that you don't need a lot of secondary indicators. I'm a former corporate statistician. I'm a certified quality engineer. I know numbers better than most people on the planet, and I'm here to tell you volatility and price action is what you need to use. You don't use derived secondary indicators or software programs to help you trade. You're just simply looking for momentum, volatility, continuation, and carefully using your brain to sort through these different charts to figure out, what's worth trading in the first place. If I can help you do that, can you agree that would be a helpful thing to do, right? If I can get you on the right side of the, scanning for what's worth trading and how to disqualify everything else, that's half the battle. The other half is your trade management on scaling in on the ones that work out and keeping real tight stops on those that don't. Who can tell me what's one of the more useful of the strategies we've covered so far? I've covered quite a bit, and it's all being recorded, so you'll get the recording soon by tomorrow. But we've covered how to scan, how to avoid false breakouts, some updated advanced tips. I've never covered that, the price action spikes and those kind of things like I covered for you today. Entering trades, kind of the step-by-step walkthrough on very specific strategies, a lot of very specific strategies. And you'll get the notes here too. It's called SaturdayBreakoutNotes.txt. I'll send that to you as a text file as well as the video. I'll put it up on the Amazon server because you got hundreds of you, so I want to make sure it downloads for you fast. So I'll put it on my Amazon server. But which of these has been the most useful of the tactics? Yeah, I'm curious. I'd like to know because and thank everybody for participating in the earlier, the survey to let me know what you're looking for, and I really appreciate that. Hopefully I'm taking action based on what a lot of you had said, speak a little slower and do a little more step-by-step, and so that's what I try to illustrate for you this morning. Am I meeting your expectations? Is that something that, I'm doing a better job of? Because I realize sometimes, I go quickly and I skip around and all that, and it can be kind of hard to follow, so I like to kind of, slow it down and step-by-step, a specific walkthrough of how to do this, right? It's the directions. This is like the owner's manual for trading, right? Probably one of my competitors listening in is going to copy that, but that's okay. I'm the most widely copied guy in the industry. Anyway, kind of the owner's manual for how to set up your trades. And it doesn't require you to buy software from some software vendor. This is good for whether you're using eSignal, TradeStation, Metastock, Ninja, whatever you're using. This is what you do, right? This is how you really trade, right? And thanks. I appreciate that. It's good to see all the excellent. Being interactive and writing helps a lot. Thanks, Ray. Okay, thanks, Ray. Yeah, I'll start doing this in all my events because I think you guys need the notes so you don't have to listen and then take notes yourselves. It's good if I can, I can send you the notes too, kind of the cliff notes, and then you can jot in your own observations and notes and print it out and all that kind of stuff too. So good to see it. Hey, thanks. Oh, no, thanks, Theodora. Appreciate that. And Richard and James and Edward and Steve and John and Joel and Ahmed and LM and Corey and Nandini and Terry. Thanks, everyone. I appreciate all the good words. Oh, no, thanks. Joel saying this approach blows away a typical trading video. Thanks. Let's see. Ellen's asking, is there any way to detect a day where you'll see a large day move like Google and IBM on the past Friday? Well, let's take a look. Yeah, sure. Let's pull up those charts. I don't trade those two instruments just because Google's too expensive. The leverage isn't good. Not G-E-G-G-O-O-G. Google. Well, what do you think? What's the price action clue? What's this thing telling you? Excuse me, I'm losing my voice here. What's the tool that helps us with this particular chart? It's very obvious, right? It just pops right out. That's your 1,500 simple moving averages, right? So the answer is yes. I would have preferred to short down here myself if I were trading this. But the clue, the technical clue is, and I was teaching my price action mastery traders this last night too, is a wide range candle after a couple of narrow flat melted candles or squished candles. So we have a nice wide range candle. That tells you you've got upcoming volatility the day after, a wide range candle. So look for that 3 candle pattern, a couple of flat candles and a wide candle. This one we had support right at that 100 MA. So that did tell you, and again, I'm a directional guy. I'd rather just shorted this at say 750, 950. That would be my favorite trade setup. But given that we did pivot, again, here's that closing range. This one didn't eclipse it, but it did find support within that closing range. So start using the closing range as well as opening range breakdowns and opening range breakouts. Look at the closing ranges, because that's the OHLC, that's the C of those four letters, that hopefully helps you get on the right side of this thing. So you could see a pivot or bounce right off of that. So that's, yeah, I personally, I would not have traded this just because I don't like buying inside range pivots unless it comes from below. But a two-day high breakout did continue up. The main technical signal, the predictive signal, is these three candles: narrow, narrow, wide at 100 moving average. Now it's not a hammer, but it's a wide range volatile, it's in play candle. They're trading that thing actively, so that tells you to be ready to trade this on the day following. Okay, just like this wide range candle tells us I would be ready to trade Google. If I were a Google trader, I'd be all over it come Monday because this is a big wide candle, right? So look for either breakout above this 50 MA, or if it drops back down into its range, the short trigger under the 796 to sell down there, or breakout over say 804 and 5. 804.50 would be where I'd buy it. Okay, but yeah, again, not a trading recommendation. You see how that works out, but be surprised if it doesn't. Usually my calls work out anyway. But so that's one of the things to look for. You're right, and that's a good question. Yeah, you got a wide range candle supported by the the obvious 50 and 100 MA lines that correctly mark out the exact support and resistance. So trading outside of that, I'd prefer to just buy this here and buy again there and buy again there, right, to scale in on a breakout continuation. But if that's resistance and you see a minor bearish upper shadow at the 50 MA, then I'd sell it, short it to day trade it back down into the range. But yeah, that's a quick answer to that. From Ian, a question is: the Forex is 24. What do I use the 5 p.m. Eastern as the close of the day each day for the last half hour? No, I will use the London, Asia, and the U.S. opens and closes. You got all the 6 different open and close data points. Don't have the time to cover all the scaling of that. What I would do is use each of the market opens and closes and characterize volatility, whether it's the London open and London close, or the Asia open and close, or the U.S. market open and close. And again, you can look at more information on currency correlations with opens and closes, and the rest of it with resources on the internet. But the main point is characterize which of the opens, which of the market opens, and which of the closes. Maybe the London open or the London close, or the Asia market open and close, or the domestic open and close, and look at patterns. Capitalize on. And again, you're not using this kind of chart. We're using this chart. You tighten in or look at the open and closing ranges for each of those and kind of look for where there's an open range push or sell-off in each correlated pair. So, and look at what the price, and visually map out the price action for the pair that you're trading to each of the different markets opens and closes, and visually search for any repeatable patterns that you can capitalize on and exploit during the upcoming, say, week ahead, or that upcoming couple hours in front of you. Do you see a repeatable pattern that was observed yesterday? And you're always looking as a price action trader. That's the kind of the hard work it takes to make trading easy. But you want to figure out for yourself, using those kind of the time intervals or that kind of closing range breakout pattern, where the trades make sense. The closing range that eclipses previous day's range, and helps you get in on the correct entries and exits. Oh, thanks. Chevrolet saying thanks very much. Learned a lot today. Yeah, I hope it's been helpful. It's a lot to cover. Let's see, from Theodora, let's see, the price action class is closed actually. I closed enrollment for that back in January. And our last session's coming up, so that one's done. The live room, though, is a good place to learn. Let's see, LS, for day trading, do I set my entries according to price? Do I care about how the candles look? The main thing is the price action. It's a story of, in day trades, we're always looking at, let me give you a good example of a day trading chart. What was the VZ was a good one. Right. Let me give you that chart. Again, I don't like I don't like Fridays because you get charts like this a lot, even though it did come to life later. If you're looking at a market open breakout, one of the things you always want to look for, let's say you were buying this open breakout, say on Thursday in Verizon, but you see a shooting star there and you see a secondary shooting star, well then you put your stop at say 5 to 10 cents under. So sometimes you will get into a cut pattern that exhausts off, and so you're always looking for 1 minute shooting stars and hammers and engulfing patterns, the width of the whole real body, momentum candles for breakout plays. And as you're looking for reversals, say if you see a hammer and you set up a trigger, say 8 cents above the hammer high, which would be here, and then again above the cut pattern high, and that gets you in on the move that continues on. And so always look for the 1 minute candles, and yes, you do absolutely, I always use candles to trade because they work. And so especially hammers, shooting stars, engulfing, and 3-line breaks, make sure you're always looking for 1 minute hammers and shooting stars as a day trader. And use that in conjunction with time and sales, which is what I teach in my live trading room with live interactive examples. But yeah, absolutely, that's important. Wow, a lot of questions. Okay, let me go through and answer these. Any questions before we wrap? I will get the entire video out to you along with this. If there's all the notes, I took a lot of notes. A question from a trader: could I have done these ahead of time? As much as I do like to put together PowerPoints, I'm kind of a here and now kind of guy. So I like to give you, the best of what I can, that's right now. So I don't typically put together a lot of notes on PowerPoint, because one of the frustrations I've seen in other people's webinars is that, they do a lot of cherry pick PowerPoint charts that just happen to magically support their positions without being real traders. And one of the things I like to do is pull up today's charts and most current market charts together. I look at the top and bottom of my quote boxes and where the best volatility is, either the up or the down charts, and be able to teach based off of today's charts, right? That's one of the hallmarks of why so many people have found value in what I have to teach, because I'm not one of these PowerPoint guys. So I apologize if I do this live for you guys, but most traders like that, because I am giving you the step-by-step and doing it. You're saying a trader had said I could be faster if I had done all this stuff ahead of time. Yeah, I guess so, but everyone else liked it, so thanks. Appreciate that. Hey, you're welcome. I appreciate that. From Barry. Oh, no, thanks, Ted. Yeah, saying compared to the regular Saturday session, this is a closer group. You're right. Hey, no, you're welcome, Mira and Terry. Let's see what else. Wow, a lot of questions. Let me go through these and see. From CP's asking, I emphasize long trades. What about shorting in a falling market? Yeah, or what I like to do is I will buy the inverse ETFs or the bear ETFs. To short, I'm always looking for bear cut breakdowns below 2-day lows. So for example, this WLT, Walter Energy, you can see again 8 cents or so. Well, 8 cents would put it at, well, yeah, right there, 18.12. Yeah. Anyway, 8 cents under the previous day's low is a good short trigger. And again, on any new sequential cut patterns, you see a descending triangle there, 8 cents under the low. So that's short trigger 1, short trigger number 2. Anyway, yeah, you're looking for short continuations in down markets using those, 8 to 30 cents, 30 cents for swings, 30 to 50 cents for swings, 8 cents for day trades for bear cut breakdowns. So yeah, good question. Chris is asking, could I review NUS, why I'd like that for a swing? Sure. Well, the first thing is, does it meet all the criteria points? So question number 1, who can tell me, does this have at least a 10% range on a 15-day chart? 10% meaning multiply the lowest number by 0.1, which would be 4.30, or just round it to the nearest dollar, is $4. So yeah, it needs to be 43 to 47, and it's in fact twice that. It's a 20% range. So that's one reason why I like it. The other is that, draw the trend line here for you, it does follow cut pattern breakouts reasonably well. You can see a cut breakout here, found support there. The cup here did a minor false breakout, but it's still in a nice strong uptrend. The other thing I like about it is that it does have at least a 3 to 4 day run in a single directional move, right? It will move 3 or 4 days, compared to some of these other charts where they're sideways chop and then moved up. This one has a nice strong uptrend. So after congestion, and it did get a flurry of buyers, but they pulled it back down yesterday. If it does take off again, it's likely to repeat a 3 to 4 or even, as we have here, a 6-day uptrend. It's likely to give us at least 3 to 4 unbroken days of a decent uptrend. So that's what I like best about the new skin chart, is it has at least a 10% range. It does have the volume of at least 1 million shares. It does have a multi-day run, and it doesn't have any major pullbacks or drops in it compared to the other charts. So this is a good, strong chart. Yeah. So that's the detail, yeah. All right, let's see. What else? I'll stick around another 15, 20 minutes. Let me try and answer questions from people who haven't asked yet. From Jerry, how about Fibonacci extensions? No, don't use them. I use 50% retracements, but that's not really the 3862, the Fibonacci's. Oh, no, thanks. Mike's saying that second scale in position is a great tip. It's something I have fallen afoul of repeatedly. Yeah, look at setting, and again, the higher the priced instrument, the further out, in terms of the number of points your triggers are. But let's say I buy 5150 on a $50 instrument, I will scale up 2 points above. So I'd buy 5150 and again up at say 53.5, and that gives me a point of pullback, chop to survive and keep the trade alive in. Okay, and you might want to, if you're going to get more specific, look at how far the pullback depths are, and you can see it's a 1-point pullback. So that's why a 2-point range extension makes sense, because you got a 1-point pullback. You can survive the 1-point pullback using sequential long. So 5150, I might run into trouble at 5250, but if it keeps running on up and I buy again at 5350, then the trade's still going to stay alive, and it will hold through a 1-point pullback. So that's one of the things. But yeah, you do want to scale and position size. From Johnny asking, what's a 1-point trailing stop mean? That means if I buy 5150, I'm going to put a stop at 5050, and I'm going to keep that stop trailing up each point. So if I buy 5150 and it keeps running on up, well, happy days. It goes to 52, 53. At 53, a 1-point trailing stop would get me out of 52 to lock in a 50-cent win. If it runs up to 54, then that gives me another point, and I trail it, it would be 1 point down, and that locks in a 1.5-point win. From BC, do I want to long only when the spider's up? A larger size only when the spider's up, but right now the SPY is still finding support off of that 50 MA, right? Still finding support off the 50 MA, so I'll still buy bounce longs, or I should say I will still buy long breakouts in the equities and ETFs I trade, but we have a bounce long pattern in the SPY. So it is finding some support here. I still anticipate it'll chop and drop. I was calling this thing short here, but if we keep support above the 50 MA, then any of these other instruments, like Disney and the rest of them that have good strong breakouts, still worth taking a shot at, but on lighter size. And you're exactly right. If the spiders were taking out new highs, the S&P and the NAS and the Comp and the NASComp and the Dow, then I would be putting on larger size in these swings. I'm doing smaller size because the broad market has been selling down a bit. But I don't want to miss out if this runs up to, say, 68. I don't want to be on the sidelines. I'd rather trade this on new breakouts. If the market's chopping and this is doing strongly in spite of a choppy or down market, I still want to trade the breakout. I control for that by trading lighter size. So, yeah, good question. For Mike, when do I move up the stop when it goes in my direction? After it's moved in my favor by at least a point. At least a point. Hey, thanks, Mike. Appreciate it. And Chris, and Russ, and Theodora, and Lisa, and BW, and Yvonne. Thanks. And James, and Jerry, and Dave. Hey, thanks, everybody. Hey, Dave. Dave G, it's been a while. I remember seeing you up in Denver, man. How you doing? Appreciate you still being here. All these years later. Let's see, from Jerry, do I use a percentage of a stock value to determine the increment of the price entry or exit? No, generally I just use points, about 1.5 or so. I like that. It makes my head hurt it's already complicated enough. I don't say, well, it's 2%, so that makes it 1.28. No. I trade so much. I keep it to the nearest point or 1.5 or so. If it's a cheap stock, I use a point. If it's over $50 a share, 1.5 for scale-in triggers and initial stops and so forth. So yeah, it's good to keep it tight. Oh no, thanks. James is saying this is your best seminar, slow and concise. I appreciate that. All right, any other questions? I got a bunch of them here. I'm trying to see if there's anything I haven't answered. Oh, thanks. Bill saying if anybody's new to trading's watching this, you probably don't know the thousands of dollars you save with this free webinar. What a gift from Ken. Thanks. Well, hey, you're welcome, Bill. Thanks. And thanks for being with me for a long time. Mike's asking, do I recommend shorts for swings? I don't like to no, I never swing trade short because the risk, I'm all about managing risk. And if something gets, I mean, let's say, you'd have gotten killed if you had shorted Vertex, right? VRTX swing trade. That wouldn't have worked out too well, right? And it's that kind of gap chart that keeps me out of swing trading short. I'd never swing trade short. I day trade short, but I never swing trade short because, what if you'd been shorting on some low and then the thing gaps against you? So that's why I never swing trade short, is because of that, right? It happens. Not often, but it happens. So I wouldn't want a gap against me, like a 30-point gap, to wipe out, a piece of my trading account because I was swing trading short and I'd have to cover at new highs. So, all right, good stuff. Let's see. Any other questions? Oh, thanks. Barry saying, fantastic webinar, brings together so many of your ideas and concepts in an easy to follow approach. Really great. Hey, thanks. Appreciate that. Yeah, I wanted to give you all a good, high value, genuine, useful, you can actually use this, kind of a presentation that walks you through some of the different thinking on how to manage your intraday and swing trades and gives you entry and exit tactics that hopefully make sense. And, I encourage you to test this out. As you test out what you've learned, remember, I'm not pitching any software or anything for that matter. Just, test this out with paper trading and demo accounts and whatnot. And, the lessons learned are always going to be about the details, devil's in the details. It's all about the very subtle entry and exit mechanics. The broad brush is to make sure you're trading the right instruments correctly, directionally, with tight stops and scaling in once they do work out. The secondary is all about how much size and how much leverage you put on that trade, and what kind of mechanics of the price action entries and exits, and managing your stops dynamically and all that kind of stuff. It's the second step. But the main thing is trade the right instruments in the right way, in the right time, and have a well thought out trading plan that makes sense, right? And you got, these are kind of the cliff notes for how to trade, and this is good stuff. This is how I trade, and I know how to do this, so hopefully this will help you guys do well too. Test it out. Test it out is all I ask. Take it for a test drive. Take it for a spin and see if it can help you improve your trades, because I certainly hope it does. Okay, let's see other questions. And yes, Bo, I will send the download link. And sure, thanks, Rita. I appreciate that. I will send the notes in the download. Appreciate. Terry saying much better. Appreciate that. Really appreciate the step-by-step. Awesome. Good job. Better now. Yes. Okay. Thanks. See, I listened to what you guys said in the survey, so thank you very much. I will endeavor to continue. Brian Tracy is my role model for how to teach. He's trained millions of people. He's a better teacher than I'll ever be, but I can try and emulate his approach. What Brian told me personally on a phone call, it was a webinar, and I had asked him, he said, Ken, because I had asked him this years ago, I told him my challenge is my customers, my traders are telling me that it's too fast, too much information. And the analogy that Brian Tracy told me on the phone was, and he's a brilliant man, he's the best role model for things in life in general. He said, think of it like a sandwich, and if you're going too fast and giving too much, stuff without putting it in context, it's kind of like feeding a sandwich where you're cramming a lot of meat down their throat and then they choke on it. What you need to do is put some bread and lettuce in there, mix it up where you're having, a fact or an example, and then, a fact or a strategy, then an example, then maybe an anecdote, then a question, then then a fact, and then a windshield wiper approach too is something he teaches in his other training. You're going back and forth with a strategy, and then a quiz chart, and then a strategy, and then a question, and then a pause. And you give people a chance to digest the information. So with my caffeinated brain, sometimes it's hard for me to slow down the pace, but I will endeavor to do that. And that came through in the survey too. still get the comments that I talk a bit fast. So I will continue to try and break it up and slow it down and make it as effective as possible so that you get everything that you need to know to be able to trade professionally, and hopefully put it in context with step by step so you can start, have a roadmap of what to follow and a blueprint for how to trade. So thanks, everyone. I appreciate it. Thanks. Appreciate reading all the, wow, a lot of comments. Like the notepad steps, where can you get a copy? Yes, I will send that out, Richard, so thanks. See, any other questions? Do I put standing from Bob? Do I put standing orders in off your notes for the next day, or do you use alerts? Yeah, I will put buy stop limit orders in using both my Interactive Brokers and Fidelity account on entries that I'm looking at trading. So, I always get the emails from, hey, trade confirmation from whoever. But, so I put in, say the 62.5 long, 64.5 secondary long in Disney. I may well put that in, this weekend or whatever in the Fidelity SEP. And then, if it fills, Monday or Tuesday next week, I'll get the trade confirmation. If I'm day trading this, which is good for day trading. If I'm day trading Disney, say in my IB account, I'm always looking for these 8 cents above micro cut breakouts to get in, first sign of 2 red candles to get out, and so kind of ducking in and out of these. So yeah, or above the 2-day high if you're going to be a little more conservative to squeeze out a trade. So good questions. From Bo, do I factor in earnings into tech analysis? No, I just like to not hold overnight for swings into earnings release because of the gaps down that I've seen so often. I still remember back in, 1999 or 2000, I held Oracle overnight into earnings. I bought it at 31 into the close using Daytech. It opened up at 15. I sat on the position for a month and a half, and it just went sideways. So I sold it at a big loss. I lost that. It was like $800. And then, after that quarter, it recovered. So 2 months later, it bounced right back up to 30. And so that I learned my lesson, 13 years ago. Don't hold into earnings. So I only have to learn it once, right? So, yeah, as far as earnings goes, just don't hold swings overnight into earnings is a good idea. Oh, hey, Arturo, thanks. Oh, yeah, I remember you had asked about the flow chart. Remember the day trading flow chart, everybody. If you don't have that, it's at daytradinguniversity.com/flowchart.htm. And put together a flow chart too, if you don't have one. For swing trading, I need to put together, I will actually, that's going to be an action item, like I need more of those, right? But one of my things I will do is put together a swing trading flow chart. I also own swingtradinguniversity.com as well as eminiuniversity.com. I've got over 1,000 domains. Anyway, I will put together a swing trading flow chart as well. In the meantime, it might be the end of the year before I get it done. I've got 1,000,001 things to do. In the meantime, you might want to put together a flow chart with some of these things to help you map out visually a process from start to finish on decision points, what to do before and after, or if then, that kind of thing. And so, map out your process in a flow chart like what I've got at that link, but for swing trades, if you're a swing trader, for whatever markets you're trading, and make it work for you. Thanks. A good question from Stan about great webinar, especially the notes. My question refers to Disney example. He's asking, what factors do I use to scale in above 65.50 if the original plans to sell the first position between 64 and 5? Well, it's only if it drops under, say, the 64.50 or under the 64, then I would sell. I want to stay long. I'd like to get in and keep that trade going long. I would scale into the Disney using a price action candle. And what I'd like to see, therefore, is, I'm not saying Disney's going to go up. This might be the top. It might very well drop down to 30 from here. So I'm not saying Disney's going to go up. Be real clear on that. I never make predictions. I just react. But if I do buy 62.5 and again up at 64.5, I want to see the same kind of pattern on the secondary entry as I do here over 62, is a wide range candle after a couple of flat candles, because usually those give you a good momentum boost. If you see a few, flat candles here and then a wide range candle, then it moves, right? Narrow candle, wide candle, it moves, right? So look for a wide candle following a couple of narrow candles. That would be what I'd look for the secondary entry. So yeah, good question, smart question. Oh, a good question from Chris about hasn't a stock already traveled too far from an entry after 3 to 5 days of buying or a wide range candle? No, because frequently these, like, this is 3 good days of buying, actually 4 days of good buying. What you want to look for is how far does it run before it rests, right? What's the price action continuation range before it goes into rest mode? And then when does it pick up momentum again and then go into rest? And when does it start to pick up again? So it's kind of inhale, exhale, inhale, exhale. Look for the cycles for how far these things run. So I don't buy, say, day 5 or 6 of a trend, because that's how far Disney's run 6 days in a row. 6 days in a row. So when it moves up, it goes up 6 days, 6 days. So if I buy here, that will be on, say, day 2 or day 3. Probably day 2, so I will expect it'll run up to 3 more days, but I'm not going to buy in day 6 of that trend because I expect it's going to at least go sideways and chop, or it might misbehave and go against me and drop back down after day 6 of a trend breakout. So yeah, good question. From Mike, oh, thanks, Mike, saying this has been great. Does the share size matter when placing a trade? And I'll stick around another 10 minutes, guys, otherwise I'll be here all day, but I appreciate all the questions, really smart questions. Yeah, the share size does matter. What I will do, and I teach this in my premium courses, is set a dollar figure that you're going to allocate to every new trade. Maybe it's only $500 or $1,000 worth of that instrument. So that might be, whatever, 10 or 15 shares of Disney. Or if you're trading 5,000 shares, and it might be however many shares that is. But set a fixed dollar capital allocation. Maybe it's 1% of your trading account or whatever that is. That's the one time I'll use the percentages to allocate capital for the trade. But, if you've got, say, a $100,000 account and you're doing 1%, then that's going to be $1,000, right? So that means you're going to diversify. You're not going to put all eggs in one basket and trade one instrument that's taking out new highs. You're going to look at scaling appropriately and, use these patterns to get in on a variety of different instruments and set up how much you're going to allocate in terms of the shares or the contracts or the lots based on those percentage numbers. So, yeah. From Mike O, how do I place orders after the market opens each day to avoid initial chopping gaps? I cover that in the live trading room, but the quick answer is I usually will wait until at least 8 cents above the previous day's high, and I will often wait until after 9:35 when I'm day trading. And usually the open range market on open orders get cleared during the first couple of minutes of the market open. I will wait until 9:35 or so. Most of my trading's done between 9:35 and 10 o'clock, and then I walk out unless we're in a big rally market, okay, which is rare. Usually I'm done trading by 10 or 10:15 at the outside for my day trade. So yeah, just wait until 5 minutes. Use both time and price. Time, wait till 9:35. Price, make it move 8 cents above a previous day's high, and that keeps you away from the opening range chop. Yeah, good question. For Martin, are the days I do not like to trade. I don't trade Mondays and Fridays. That's why I run my live trading in the open room on Tuesday, Wednesday, Thursdays. Monday and Friday, and also days right before and after major holidays tend to be light volume chop days. So that's why I've trained thousands of traders to focus our energy on the opening range breaks during the midweek days, Tuesday, Wednesday, Thursday. Good question. Oh, no, thanks. Thanks from Padma. I appreciate it. Learned a lot of good tips today. I'm a visual person, too. Right. From LE, what's a 3-line break? A 3-line break is where you see 3 sequential stair-stepping candles where the whole real bodies are above each one. And you can look at Steve Nissen's Beyond Candlesticks book or Google it, but basically that's it. You're looking for, what I like to look for are 3 sequential candles, preferably where the third whole real body is bigger than the first 2. If you see a narrow candle following 2, this is not technically a 3-line break because it overlaps a little, but technically it's when there's 3 that are on top of each other like stair steps going up to the library or town hall or whatever. If the third whole real body is narrow, then that means it's usually an exhaustion pattern and will not keep continuing. If, however, it's a big candle, like here's like baby bear, mama bear, papa bear, if you see a 3-line break pattern like this where the whole real body is increasing, then I like to buy the cup patterns above that high because that usually leads to a continuation in price action. So for a 3-line break, I mean, you can Google it, but that's one of my favorite patterns. The trick is just doing that. I look for those three-line breaks exclusively, in which the third whole real body is bigger than the first two, and that's a good momentum trigger professional traders like to use, and it's something, I'll share with you guys as something to use too. So a simple moving averages on stocks, exponential on Forex for Terry. From Arturo, what are the tickers I use to get the sentiment of the market? I use the VIX, the trend. I don't use the tick as much, but I will use the ARMS indices. The trends tell me market directional bias. Trends are and there's one for the NASDAQ market and one for the listed market. Sometimes they're divergent, sometimes they're convergent. Make sure you have both of them. They're really important if you're a day trader, especially using your trends. All right, let's see, any other questions? I think that's about it. Oh, thanks. Jimmy's saying no matter what your style, education's still the best. Thanks. I'm going to try and slow it down a bit and be a lot more step by step, because I think that's what helps you understand. And I relate to that looking at the charting software. Even the video tutorials, some of them are pretty good, but a lot of them aren't. As with my training, I teach tens of thousands of traders. I want you guys to get step by step what to do when you see this, right? What's the if then? Put things in. It's another parting tip here is put your trading decisions in an if-then conditional format. For example, if markets inside prior day's range, then trade less or skip that day. It's kind of the most important tip of the trader. If my trade goes in my favor 2 points or better for a swing trade, enter a second position to scale in or position size in. And have a series of those kind of if-then as part of your trading plan. What are the if-thens that you do as a trader to keep you in on the right trades and out of trouble? So, all right, I guess that's it. From Rich, do I use the 10-day MA? No. No, I use price action breakouts, because that's usually what gets me in on good trades, is the strongest to what's out there. Hey, sure thing, Mike. I understand where you're at. It's take time to filter out. Take time to be very selective. Whereas say before you might have taken 6 out of what looked to be good out of 20 setups. Now focus down to say the strongest 1 or 2 out of 20 setups. Be much more selective. Oh, no, thanks. Mark saying, never knew it could offer so much of a presentation, so amazingly clear, wonderful pace. Much appreciated. Thanks. From Richard, do I trade the double and triple index ETFs? Yeah, all the time. I mean, I've got hundreds of examples at tradingtalk.com, my forum, where I've screen capped all the examples. I like FAZ's historically been my favorite for the triples, but yeah, I trade those all the time. I trade my inverse ETFs are my favorite instruments for ETF trading. And I like the FAZ. There's even things like the TVIX and so forth. I don't like that one as much. But yeah, the doubles and triples are good, especially the triples. Like FAS, FAZ, I pair trade those, right? The financial bull and bear triples, ERX and ERY. And I teach more how to do that at etfmastery.com. But yeah, and I've got lots of videos on that too. But yeah, absolutely, I trade those. Hey, thanks everybody. Appreciate it. Oh, no, thanks, Mike, saying this is the best I've done. Appreciate that. From Sil, thoughts on UHS? I got to run, guys, because otherwise the video is going to be, I don't like that chart, and I wouldn't trade it. No good. I mean, why would I trade that when I could trade, I don't know, Merck or VZ or Disney or any of those, right? Those are better charts. So always think about being a skeptic of things that aren't working out, and focus your energy as a trader. The best advice I can give you as a trader, from one working trader to another, is focus your energy on you should make a big deal out of Disney. It's kind of the kiss of death, right? I already talked about it. It's it's destined to drop down a lot, right? That's would surprise me. Or Merck or any of these others that are good, strong charts. Make sure that you're focusing your energy on those charts that do have the strongest price action, on good volume and solid volatility that makes it worth a trade. So thanks, everybody, for being here. I appreciate it. Yeah, from Ian, the notes will be printable. It's just going to be a simple text file, so you can file print and print those out. Oh, no, thanks, Ted. Yeah, appreciate that. Do I have a trading room? Yeah, I'm running after an 8-year break, the Trading the Open room, at least through the summer. I don't know if I'm going to run it after that, but it's been popular, so may keep it around for a while. And hey, you're welcome, Faye. Appreciate that. Thanks, Yvonne and Joel and BC. And that's it. All right, thanks, everybody. I appreciate it. Y'all have a fantastic weekend. Thank you so much for filling out the survey. I do appreciate it. I will take action. Close to 1,000 comments from all the 270 traders so far that have filled it out. It's probably more now because I haven't checked since I posted the link in the Saturday event. But I really appreciate very much you taking time to fill out the survey. And I hope that this hour and a half with me has given you a pathway to hopefully becoming more successful as a trader and giving you some good, honest tips to help you, do better. So test it out. Test out what I said and realize that you should be patient with yourself. As my colleague Peter Bain and also Steve Nissen would point out, trading takes a lot of years to learn, and so don't expect, instant success. It's much tougher than it looks. And it's, the success tips are all about scaling, about risk management, about not being dependent on some proprietary software as part of your trading life. It's much more about do it yourself. Break out the Craftsman wrenches that you got from Sears and go to work on the car, the 9/16 wrench or whatever, and take apart your car and fix it yourself. And that's what trading's all about. It's much tougher than the industry, as the general would have you believe. It's very, very difficult, and it may take years to get to break even at best. So don't expect too much out of yourself or the markets. Be careful. Trade outrange days. Look at developing a process. I want to give you some hope, but also be realistic and go into it eyes wide open. It's a movie title would say. Make sure that you're looking at these strategies in a way that can help you, potentially improve not only how small your stops are when you're wrong, but selectively focus on the strongest of the patterns out there without any special magic software indicators or that kind of stuff. That's not how you really trade. Real traders, it's all about risk management and scanning, right? It's scanning for what's worth trading, and then managing as many trades as make sense for your particular situation as is possible, and leverage into those so that you can work in and out successfully over time. And remember, it takes a while. So anyways, that's it. I'm Ken Calhoun, Day Trading University. I want to thank you all for being here with me on this Saturday, and that's how you really trade. So I gave you my best. I hope that it's of use to you, and I will send you the video link. Should be up later today, tomorrow at the outside, so give me till tomorrow lunchtime, and I'll get you this entire video. I'm still recording it, so it's only going to be a 500 megabyte big video, but right-click, file, save as, and you'll be able to keep it. And that's it. So thanks so much for being here. Take care, everybody, and best wishes for success. Goodbye.